All right, quick question. What happens when you combine RSI and MACD into one simple strategy? Sounds basic, right? Well, I back-tested it against the S&P 500, and the numbers were way better than I expected. Let me show you the real data. But before we jump in, here's the deal. No cherry picking, no fancy filters, just a straight-up rule-based test. And honestly, if a simple setup can beat passive investing even by a small margin, that's a big deal for traders like us. So let's break this down. So first things first, I wanted to see if this combo actually creates a consistent edge or if it's just another looks good on paper setup. So I ran it across different market conditions, bull runs, crashes, slow chop, everything. No mercy. And the crazy part? The strategy held up way better than most people would expect from two basic indicators. All right, so here's the backtested data for the S&P 500 for the month of August. I dropped the file link in the description so you can open it up and check everything yourself. Full transparency. And just a heads up, the kind of trade setups this strategy give are mostly swing trades or intraday moves. So if you're planning to actually use this strategy, make sure you plan your entries and expectations around that. Let me walk you through the data points real quick. In the first column, you've got the date. Then in the second column, you'll see the entry time. Since this strategy is running on a 5-minute time frame, an entry time like 10:30 basically means you're entering at 10:35. That's the 10:30 candle closing and the 10:35 candle opening. Next up, you'll see the exit time column. And you'll notice I added little brackets like +4, +1, +6. That just tells you how long the trade was held. So if it says +4, that means you're exiting the trade 4 days after the entry. If it says +1, you're closing it out the very next day, and so on. Moving on, the next column is position. This one's simple. It just tells you the direction of the trade. If it says long, you're betting on the upside. If it says short, you're playing the downside. Nothing complicated there. Right after that, we've got the RR column. That's your risk-to-reward ratio. And trust me, I tested a bunch of different variations, but the one that consistently made the most profit was 1 to 1.5. So if you're planning to use this strategy, stick with that. Don't tweak it. Next column is pretty straightforward. TP means the trade hit take profit, and SL means it hits stop loss. And finally, the last column shows the exact number of points you gained or lost on that specific trade. Super simple. So now that you know what all the data points mean, let me break down the actual strategy rules. Before we jump into the actual strategy rules, let's set up the chart the right way. First, open up the S&P 500 chart and set the time frame to 5 minutes. Go to the indicators section, apply the RSI and MACD indicators. Now go into the RSI settings and uncheck the RSI-based moving average, the middle band, and the background fill. And make sure the other two boxes stay checked. Those are really important for this strategy. Then hit OK. For the MACD, don't change anything. We're using the default settings exactly as they are. All right, now the chart is set up, let's talk about the rules. Rule number 1, we're only taking reversal trades. Since this strategy is built around RSI overbought and oversold zones, we're strictly trading reversals, not trend continuation setups. Rule number 2, for a long trade, the RSI has to be in the oversold zone. And for short trade, the RSI has to be in the overbought zone. But here's where most people mess this up. RSI just dipping below 30 is not an oversold zone. It has to actually drop below the 30 line and stay there for a bit. When it does that, the RSI creates a red background, and that's what confirms a valid oversold zone. If it dips below 30 for one candle and instantly jumps back above, that does not count. Same logic for overbought. RSI crossing above 70 isn't enough. It needs to hold above 70 and create a green background. That's the real overbought zone. And remember, RSI only triggers the setup. It doesn't confirm the entry. We still need MACD to confirm the actual trade. Rule number 3 is the final step. This is where we actually execute the trade. So once RSI gives us a signal by moving into the oversold or overbought zone, the next step is super simple. We confirm it with the MACD crossover. In the first trade example, you can see the RSI dropped into the oversold zone. That means we've got a long setup triggering. Now all we do is wait for the MACD crossover. As soon as the crossover happens, we enter at the close of that candle. In this case, the MACD crossover happened on the 10:30 candle. So the entry is either at the 10:30 close or the 10:35 candle open. Now let's talk stop loss, because everyone says put it below the recent swing low or above the recent swing high, but nobody tells you exactly how much. Today I'm giving you the exact formula. For a long trade, mark the recent swing low with a horizontal ray. Note down the value and subtract 0.1% from it. For example, the swing low here is 6,214.43. So we subtract 0.1%, which is 6.21443, and that gives us 6,208.21. So your stop loss is 62.08. And like we discussed in the data table, your take profit stays fixed at a 1 is to 1.5 risk reward. For a short trade, it's the opposite. Mark the recent swing high, note the value, and add 0.1% to it. In the second trade example, the swing high is 6,346. So we add 0.1%, which is 6.346, and that gives us 63.52. That becomes your stop loss for the short. And again, target stays at 1 is to 1.5 RR. Now, one important thing before you rush to try this out. This strategy is not about taking a lot of trades. Some days you'll get no trades at all, and that's completely fine. The edge here comes from being selective, not being active. You're waiting for RSI to actually spend time in the zone, then waiting again for MACD to confirm. That patience is the cost of the edge. And just to be clear, this is not a holy grail. You will take losses. The goal isn't to win every trade. The goal is to make sure the winners are bigger than the losers. That's exactly why we lock the risk to reward at 1 to 1.5 and don't mess with it. If you start changing the rules midway, moving stop loss, taking early profits, skipping confirmations, the edge disappears. This only works if you trade it exactly the way it was tested. So trade it slow, trade it disciplined, and let the math do the heavy lifting. So that's the strategy: clear rules, quantified risk, and no guesswork. Now that you know the exact rules, go back and recheck every single trade in the data table. You'll see how each entry, stop loss, and exit follows the same logic. And if you have any doubts or questions about the strategy, drop them in the comments. I'll clarify them. That's it. Trade with discipline, respect the risk, and I'll see you next time.